So, Ask the Advisor is an area where we cover questions. We use our experience and knowledge to cover any questions that are cropping up for our members. And today, the 12th of June 2025, we're expecting to cover 4 questions that we've had in advance and any that come up from our audience. So yeah, we've already got some starters and we're ready to take them live as well. Our next session for this is the 11th of September, 7 o'clock in the evening. So if you want to pop that in your diary, then you know when the next Ask the Advisor session is. And we've also got some other sessions coming up for Finance on Friday and Habitudes, which I'll let you know the dates at the end. By attending the Ask the Advisor webinar, you do gain entitlement to our free membership of the Women's Wealth Network, our Enable membership. So Carolyn's going to post a link in there. If you haven't already taken advantage of that, then please do. And you simply bypass the £12 a month option and enter the code webinar, and then you'll get lifelong access to the learning on there. So this is a chance to ask your burning questions. We want to be helpful. I'm here with 30 years experience. I'm feeling it today as well. I think it's 7 o'clock in the evening I start feeling everything of the 30 years. And I'm also a columnist for the Telegraph, and I founded Women's Wealth out of an absolute burning passion to help women level up in the area of finance. We've been underserved and underrepresented for a great deal too many years, and it's time for us to do everything we can to change that for ourselves. So that's what I'm here for. We have a podcast called Her Fabulous Financial Future, and you might want to have a listen to that if you want to hear how we've helped some of our clients and their stories. I find it very inspiring sometimes to have a little listen to those. Carolyn is dropping the link in the chat so as you can find that. So, questions we've already had posed today. I'm just going to let you know the headlines. So, what's the real difference between a financial advisor and a financial planner, and which one will actually help me control my money the way I want it? I need that help. So that's one question. The other is, should I lock my mortgage rate in now or should I wait? It seems like they might be going down further, but I don't want to miss the boat. And then I'm going to be tackling, so Yulia's going to be helping with those two, and I'm going to be tackling the fact that some people care about where their money goes, but they don't necessarily want to avoid backing defence with it, but they don't really want to be in weapons. So it's kind of, how do I navigate this if I want to have some but not all of my my investments dedicated to defence? And the other one is, why is so much of my portfolio still weighted into the US when it seems like the US economy is all shaky? So those are the topics that you've asked us in advance, and we did a little bit of a poll to see which one was most important to you wanted answering first, and it turned out to be the difference between financial advisor and financial planner. So we're kicking off with that one. If you have any questions, please do put them in the chat. And if you're happy to come off your mute and ask your question, then put your hand up and we'll come to you and bring you into the meeting. Here we go then, Yulia. Thank you very much for joining us. Yulia's been a money mentor with Women's Wealth for, I don't know how many months now.
Almost 5 months.
Yeah, so this is her first Ask the Advisor session, so we have to be gentle with her. So Yulia, what did you think of this question about the difference between a financial advisor and a financial planner?
Thank you, Sam. That is really a great question. So financial planners, they usually take a holistic approach. They often work with lifelong cash flow modeling scenarios that map out your financial goals, be it purchasing of a first house, planning your retirement, or sending your kids to university. So that's where the main benefit. They work with you to achieve your long-term goals. With financial advisors, they are authorized and regulated to advise and recommend products. So they are mainly handling transactions. And financial advisors, they can be independent. That means that they can advise on the whole of the market in terms of product, and they're also restricted or tied. So they will be tied just to distribute or recommend a product of a particular provider. So with Women's Wealth, we are, as our sign says, we are a firm of financial planning and advice for women. We are independent, and we're having a fair charging structure. So if you would like to work with us, you do not have to have assets under management requirement. We're happy to assist you with financial planning, and if you require then financial advice, we're able to help with that as well. Financial planners, they can do both financial planning and financial advice. I hope that makes it slightly clear what the main difference between financial planners and financial advisors are.
So if I had my mortgage maturing in a couple of months' time and I wanted to get a new mortgage deal, would I need a financial advisor or a financial planner?
So to address that needs, you will need a mortgage broker, really a regulated mortgage advisor, to offer you a solution for this particular situation. Yeah.
Okay. All right. So it's more about the transaction. It's a product I want.
Yes, exactly. That's the transactional side of things. Absolutely.
And then if I wanted to kind of look at my ISA and my pension portfolio and work out how long they're going to last me when I stop working and which one I should use first, who would I use for that?
So financial planner will be able to help you with those questions, because they will be working with your objectives, with your long-term goals, and they will be able to offer you the best solution in terms of plan, and also recommend what's the most best possible route for you there.
So that long-term strategy stuff is definitely in the plan.
Absolutely. Yeah.
When it comes to which product to use, we're more into the kind of advisors domain. Okay, thanks for that. Thanks.
Sorry, Sam, I think there might be a question.
Okay.
It's about IHT question, inheritance tax. I own my house with my dad, and I have paid off the mortgage for my house. If and when my father passes away, the house will obviously be left to me. But for IHT, would I have to pay this even though I own the house?
No, if you're not inheriting a house you own the house. If it belonged to your dad and he died and passed it to you, then you would have an inheritance tax bill, possibly. Actually, no, not if it's your father. Very likely that it would fit within the exemptions. But if he doesn't own it, if you do already, then there's going to be no inheritance tax if he dies. Have I answered the question? Did I understand it right?
I think so. Yes.
Sorry, I'm trying to come off mute. Sorry. Sorry, it's Jessica here. I asked the question. So basically, can you hear me?
Yes.
Yeah.
So I put my dad's name on my property, on my house, because if I get married in the future and divorce, I don't want to lose half of my house. I'd rather lose, whatever it is with me and my dad both owning it together, whatever percentage that is. But, with all the inheritance tax talk on the news and everything, because my dad's name is on the property, he obviously owns half the house, right?
Yes. So
if and when he passes away, what happens then? Because obviously,
I
need to read his will.
How do you own the house, Jessica? There are two ways of owning it.
I've paid off the mortgage fully. I've paid off the mortgage fully. So
no, hang on a minute. Let me finish, because there are two ways of owning the house, regardless of whether it's got a mortgage.
Okay.
Tenants in common, and if you're tenants in common, then your will decides what happens to your portion of the property. If you're joint tenants, the portion of the property goes to the survivor. So do you own the house in such a way that if one of you dies, it all belongs to the survivor? Or do you own the house in such a way that if one of you dies, the will of that person dictates what happens to their share?
That's a good question. I don't actually know. How would I know that? How
You would need to look at the conveyancing and the deeds, the
Okay.
legal arrangement that you set up when you gave your dad a part ownership. Was it half and half?
Yeah, it's basically both our names are on the house, so half and half. Yeah.
Yeah, okay. It sounds like it's probably joint. If you think it's half and half because both your names are on it, it sounds like it's probably joint ownership, and it would all belong to the survivor if something happened to one of you. But you do need to know whether that's the case.
Okay.
Because it is possible that if you and your dad, I don't know, had a falling out and your tenants in common, your dad could will his half of the house to his new girlfriend.
Oh no, my mother would not let him have a girlfriend.
All right, okay. So your parents are still together?
Yes. Yes.
Okay, all right. Okay. But but you don't know who's going to die first, really. And you don't know what the future holds. So like, you don't know that your dad's will leave that half of the house to you if he dies.
Okay. So I need to,
You
it's
do
the
need to
tenants
know whether it's going to be automatically yours if anything happened to him. From an inheritance tax point of view, I doubt you've got too much to worry about because, oh no, it's not his principal main residence, is it? It's yours.
No, it's mine. He has his own house with my mum.
Right, okay, so it's not his principal main residence, so it very likely could be subject to inheritance tax then. Yeah.
So I would have to look at the conveyancing documents.
Yeah, you need to know how it's owned. You need to know what's going to happen on death. So it's something you're going to have to take advice on. It's a bit too complicated to sort out in a forum like this, I think.
No, okay, well, thank you. No, thanks.
You're very welcome. I wish I could be more succinct in my answer, but there are too many. But what if it's like this, if it's like that, if it's like that?
Yeah.
But it's not his principal main residence. So if it's an asset passing to you and it's outside of the nil rate band or exemptions, then it will be subject to tax.
Okay, all right. Okay, thank you.
And as you say, inheritance tax looks like it's going to get sharper and steeper
Yeah.
than anything else. So,
yeah.
Okay. Sometimes we think we're doing the right thing, Jessica, don't we, in protecting ourselves? And what we do is we build in another problem. And I think that's always the trouble with trying to manage assets, is that you can't really change the shape of ownership without causing other liabilities, whether they're tax or whether they're maintenance liabilities of an asset, or, there are always other unintended consequences. So,
okay. Thank you for your help.
You're welcome.
That was a great question.
It was a great question, yeah. Testing our grey cells right off the bat. So thank you, Jessica. So we've got another question here, which is about mortgages and whether we think rates are still going down. So if you want to fix your mortgage, is this a good time, or should you maybe track for a while longer and see whether they go down further? And Yulia's had a little look into where she thinks the market is and what she thinks the advice is around this at the moment.
Yes, another great question. So current England base rate is standing at 4.25, and there is a forecast that towards 2026 the rate will come down to 3.5 or 3.25. So with the way things are going, is probably better stay on tracker rate if you can, of course, afford the risk of the interest rates going up, so temporarily until they eventually come down. So, and at the moment the mortgage market is extremely competitive. It's just worth looking for a best deal for yourself. And as far as I know, there is a new lender that has come up on UK market, which is called April Mortgages, which are offering 100% mortgages to first-time buyers, with the earnings starting of £24,000, and there's a number of other criteria, but that's an excellent way of entering the property market. But to answer the question, I think whether rates are, if you can take out 5-year fix at 3 or 3.25, I think it's the great deal, and one just has to snap it. Yeah,
okay.
It'll be perfect.
Right. Okay. So you think once they get to 3.25, 3%, if you're looking for like a 5-year fix, you probably need to go for it at that point.
Yes, I would personally do that as well. Yeah, I think it's a great rate and fixing for 5 years with a stable economy. Yeah.
Some rates taken out like 5 or 6 years ago might be at 2%.
Yes, but we were in a different economical situation. This rates, I don't think we will see this rates within the next 5 to 10 years anyway. So yeah, just to hedge the risk, I would fix a 3.25 for 5 year. Just
Yeah, okay. At the moment, though, you can't get that, can you? At the moment, it's still coming out at like 4.5 or somewhere around there.
yeah, it depends of your
Okay.
loan to value, but you're right, is in the region for 4.25, 4.5. Yeah, yeah.
Okay, all right. So we're still waiting for those interest rates to inspire lenders to come to the market with more competitive fixed rate products.
Yes, I would agree with you on that. Absolutely.
Okay, I do think we've had another question come in, which is a good one from Janet. Hi, Janet. Do you want to ask it yourself or?
Yeah, no, it's partly that I remembered I had a commemorative gold coin in the cupboard somewhere, and I found it, and I looked up what they were selling for on the internet, and I was shocked at how much.
Pleasantly shocked?
Yeah, well, yeah, I mean, because when somebody bought it for me, and it's like increased in value a huge amount, and I was thinking, well, I should just go and buy loads and stash them under the mattress or something, because I don't know how you pay tax on it increasing in value, but I was taken aback.
Okay. Well, the answer is if paying tax on it, it's a commodity. So if you sell it for more than you bought it for, that's a gain, and that gain is subject to tax if it's more than a couple of £1,000. So you declare it to the tax man as a gain, and you pay capital gains tax on it because it's not income. It is a gain. Because it's a commemorative coin, it probably comes under collectibles or chattels. So you probably get away with actually even chattels, personal chattels.
Do they still use that?
I know, it's a typical HMRC word, isn't it? Personal chattels.
No, it's just because women used to be described as chattels, didn't they?
Well, thankfully, the HMRC have modernised taxation and treat us equally to men now. But yes, we did. We used to be a chattel. But you still have personal chattels. It's just women aren't included. Progress, Janet, progress, not perfection. Okay, so gold as a commodity. I think it's really important for me to explain my thinking as a financial planner on the difference between gold as a commodity and investing. So gold never has the capacity really to be anything more than gold, any more than a pork belly does, or a coffee bean, or Bitcoin, frankly. They're all things, and they're commodities. And the thing that changes the value of them is how many other people want to buy them at any one time. So it's a supply and demand issue. With gold, it's a little bit different with gold because gold can be a commemorative coin, and that might have a sentimental value or a historic value, which people will pay for, as well as its root, like precious metal value. So there is a little bit with gold that it can be something more than just gold, but actually most of the time gold is priced at its weight. That's what it's really worth, its weight, worth your weight in gold, as they say. But the value of gold changes depending on how many other people want it at any one time. With investing, I like the idea that with investing, you have something that's worth more than the sum of the parts. So if you buy shares in a company, you are buying into the enterprise value of that company bringing together some of these commodities, but combining it with ingenuity, human labor, creativity, productivity, and creating something that is worth more than the sum of the parts. So that's where you get enterprise value. And if you lend money to companies or buy their shares, then you as an investor deserve some of the premium of that enterprise value. So it has the potential to be worth more in the future than it is today. And that's not just based on supply and demand, although there will be an element of that. If you buy something that nobody ever wants to invest in ever again, then you've got a problem on your hands. But if you buy something that's the good and great companies of the world who know how to carry on producing and doing it well, then you'll always be able to share in the profitability of that company. So it's the enterprise value that makes the difference between investing and commodity trading, which is just a supply and demand, short-term price arbitrage situation. So I consider them to be two different things. One is for short-term profiteering, and some people are very good at it, but lots of people get it horribly wrong as well. Whereas investing, especially the science of investing, with a bit of data behind it, you should be able, if you're patient, to get a good return on your capital. So is gold a good thing at the moment? Gold is certainly well priced at the moment. But in my reckoning, I know human beings aren't very good at selling high and buying low. We always think that if something's doing fabulously, we'll have more of it, please. When actually, when something's doing fabulously, we should be flogging it off quick while it's high in value. And we should be buying something that nobody else wants, which is low in value. But we don't, as humans, generally do that. We tend to buy more of something that's already quite pricey. Which is why we get bubbles. So we're not well cut out to be statisticians around working out when to buy and sell the assets that we hold. So sometimes it's better to rely on some sort of mechanism that does that, rather than try and guess where a market is and whether you're buying or selling in it. But I do think your commemorative coin sounds very interesting. Would you sell it anyway, or would you want to hold on to it for its sentimental value?
Oh, I don't know. It was a gift, and it commemorates when the Queen Mother died. So I don't know, 2002 or something. I think it's a gold crown. So in a box, and
nicely presented.
Never touched it. So
well, they used to put 2p coins, didn't they, on the bodies that they floated into the water to pay the ferryman. So like. You could, or your gold tooth or something like that. So like gold has always had a place as a piece of wealth, but I don't see it as a long-term investment option.
But I think it cost its face value plus whatever the decorative box cost, and it's several £1,000s now, which is ridiculous. But need to look in more cupboards.
Some more collector species.
Thanks, Sam.
Thank you for your question. Okay, so we've talked about mortgage rates. We've talked about the difference between a financial planner and a financial advisor. We've talked about some inheritance tax issues and the complexity of sharing property ownership and how things can change over time, including the tax rules, and catch you out on that. We've talked a little bit about gold and whether that's a good thing to be holding, buying or selling at this time. And I'm going to tackle the next question on our list of pre-asked questions. So this one's a bit trickier to answer, so bear with me. It's kind of got it depends answer, I'm afraid. So the lady said, I care about where my money goes, but is it possible to invest in defence without backing the wrong kind of weapons? So I think she particularly didn't want to be involved in any weapons of mass destruction or things that are used, really brutal weapons. But she's thinking, well, we need to defend our borders, like when our greatest allies of the past are starting to make decisions that worry us and we want to be able to be more independent about our defence decisions, isn't it time we started investing more in defence? And there's certainly a lot of money being invested in defence at the moment. But if you've got an ESG, or that stands for environmental, social and governance portfolio, or socially responsible investment choice in your portfolio, then it probably isn't investing in defence. So if you wanted to move towards defence and stay in ESG or socially responsible investments, so not the wrong type of defence, then can you do that? And the answer is it depends. The regulator has done quite a lot recently. There's a new spaghetti soup of acronyms around what the regulator is doing, around making the disclosure of what ESG or socially responsible or ethical funds invest in, making that disclosure tighter so that investors can be confident that right back to the company's boardroom, it's all been audited, what they're up to and what they're doing. And so, but a lot of that is focused on environmental issues, whether their practices are sustainable, what impacts they're having on the environment, rather than, whether they invest in weapons or defence stocks. So it's not the new labelling was never designed to make defence part of the discussion, and the FCA makes it quite clear that they are agnostic about whether something can be considered sustainable and still be invested in defence stocks as far as they're concerned. So companies, however, and investment managers may have a very different set of criteria that qualifies them as sustainable or whatever category they want to fit into, but doesn't allow them to invest in, weapons or defence or anything like that. The managers that we use most are Parmenion, Sparrow and Timeline, and none of their ESG portfolios invest in defence. And when I spoke to the fund managers about why not, it's quite simply that they don't know where to draw the line between good and bad. And that if they do engage in invest in a company that is investing in defence, the thing it's defending this year might not be the thing it's defending next year. So they move the boundaries, and it might not be a good time to disinvest. So you're then stuck with an investment that's now doing something that it didn't used to do, that you're not so comfortable with, but it's not a good time to take your money out. So they just don't do it. They just avoid it because they don't know how to do it. The other part of this is governments. Lots of portfolios invest in fixed interest securities with governments. In the UK, if you invest in the UK government, it's called a gilt. If you invest in the German government, it's a Bund. If you invest in America, it's a treasury bill. So there are different ways, they're called different things, but they're effectively loans to governments. And of course, governments have big defence budgets. And, the Chinese government and the German government and the British government will be, they will be defending different things for different reasons. So but they will be investing money in defence. So it's a difficult one. We as advisors tend to encourage clients to go light green and use fairly passive, well diversified options for ESG and socially responsible investing, and not get too hung up on particulars. So if you are somebody who is particular, and we do have some clients who are particular, then it gets quite a lot more expensive to have the right screening in place and to work with a fund manager who really is doing it your way and is very strict and controlled about that. So that's the best answer I can give. Defence is not particularly excluded from ESG and socially responsible investing by the regulator in terms of the categories, but if you're going to have government loans in there, you're going to be investing in defence. And portfolios with no government bonds in them are very volatile. So the market for green bonds is tiny. There's not enough green bond issued to fill the market, to meet the market demand. So I think having a light green approach will allow you to stay in ESG and not think too specifically about how governments are using the money that your portfolio might be lending them. So I hope that helps. I hope that helps.
Sam, so can I just then ask, so you've touched on governments spending on defense, but when it comes to private companies, so for example, if Microsoft, which is a very well-known company, and they obviously produce software, Microsoft 365, what about a defense company that may potentially use their software? So where do we draw the line? How do we exclude them? Or what do we do?
It would be a very brave portfolio manager who was going to exclude all technology stocks on the basis that a government might use them in a defence project. So I think some technology is very obviously designed to support weapons and defence. But satellites. The satellite network is massively important to the defence industry. It's also massively important to my subscription to Netflix. So it's kind of like, it's like where, as you say, where do you draw the line? The network, anything can be a weapon, can't it, really? I use a knife and fork for my dinner. The fork could be a weapon. That's not what they were made for. So I'm not going to not invest in cutlery companies because my knife might be used as a weapon. So it's that type of thinking, isn't it? You have to kind of some things are very obviously not something people would want to be investing in. And if you want to get quite particular about that, you can screen those things out. But I think it would be a very brave person who screened out all technology just in case any of it got used in weaponry. We need technology, and technology needs investment. So.
Yeah, absolutely. Totally agree.
Thanks for your question. I think Jessica's got another question for us. Did you want to come off mute and ask it, Jessica?
Yeah. So I'm an additional rate taxpayer,
Right.
And so I'm trying to reduce the amount of tax I have to pay, and I'm trying to add more into my pension, so increase my pension contributions, and I'm using is it AVP? I can't remember the acronym.
AVC, additional voluntary contributions?
Yes, thank you. AVC, not AVP, AVC. So I'm using AVC to make additional contributions to my pension. But is there a calculator? Because apparently, is it correct that you can only add 60K to your pension annually?
Okay, well, there is an annual allowance of £60,000 a year.
Yes, I don't want to go above that. So is there a calculator that someone can use? They input their, the amounts, and then you can say, right, that's what you've got left over, and that's how much you can contribute into your pension.
Okay, if you're using an AVC, it sounds as if you're in a company pension scheme.
Correct.
Company pension schemes normally operate through an online portal, and the online portal almost certainly has a calculator on it. So I would start there. You're going to need to work out what's already being paid into the pension by yourself and your employer.
Yeah.
And so as you can work out what's left. And if it's, as you're right, if it's being paid in by salary sacrifice, it's not just the number by which your pension has gone or net pay has gone down that is going into your pension, because your net pay is the pension will be going out of your gross pay, and you'll have less national insurance and tax being charged on your wages. So you can't just say the net amount that your wages has changed by is what's going into your pension. That won't work. You do have to work out the gross figures before tax and national insurance is applied, and work out what that contribution is to the pension. Even if it is done via salary sacrifice, you still need to know that gross contribution figure.
But even let's worst case scenario, my employer doesn't have this calculator on their website. Is there an online calculator?
Yeah, HMRC do calculators.
Okay.
A lot of the kind of money sites like Martin's Money and what have you do calculators.
Okay.
I would assume AJ Bell and Hargreaves Lansdown will have a calculator on their platform as well.
Yeah.
Okay, great.
So yeah, there are all sorts of calculators out there. It is not an easy calculation to do when you're, and I'm assuming, do you earn over? Well, I don't want to ask you how much you earn, but if you earn over 260,000, then you have to do an additional calculation, which means your £60,000 allowance might have been reduced to as low as 10,000. So it depends what level of earnings you're on, whether you have a £60,000 allowance. It could be as low as 10. You need to do that sum as well. And then if you want to pay in more than 60,000 and you earn more than 60,000 and you haven't used all your allowances in the last 3 years, there might be some opportunity to contribute more this year and use unused allowances from previous years. So, working out what the maximum you can fund a pension at it's got like 4 different elements to the calculation.
I'm finding the overpayment, the past contribution, that I can't. I'm not a whiz at math, and that what you're saying about the previous year contributions, that gives me a headache trying to calculate that.
Yeah, I mean, it should be on your statement. You should be given every year by your pension provider.
Yes.
An annual statement which clearly states what's been contributed. Yeah, so you shouldn't have to work it out. You should be told it. And if you didn't contribute the 60,000 that you can in the last few years, then you might have an opportunity to bring forward that unused reserve.
Okay, all right. Thank you for that.
All right. It's how we earn our keep, Jessica, is doing maximum funding pension calculations for people, especially people who are paying serious rates of tax. And want to save that tax. So that is, the calculations are complicated. Even a whiz at math struggles with them. So like, don't beat yourself up too much about it. Pensions are unnecessarily complicated, and that's
okay. Because also I have to take into account I've got a cold, so my brain isn't working. The tax relief as well, the government tax relief. Do I have to take that into consideration as well?
Well, if it's being done by salary sacrifice, then there is none.
Ah, okay. Thank you for letting. Okay, right, understood.
There's no tax added. The tax relief is given because your salary was reduced.
Right. So that's one part of the calculation I can ignore. Okay.
Assuming the ABC is done on a salary sacrifice basis.
Yes, it is. Yes.
Yeah.
Okay.
Right. Pensions are complicated, Jessica, and I would suggest that if you're paying serious rates of tax and you're funding a pension to those levels, then the cost of advice is very, very justifiable in terms of making sure you get it right. So.
Okay. Thank you.
You're very welcome. Thank you for your questions. Anybody else got any questions before? If not, I'll tackle the last one on my list, which is about my portfolio still being very stuck into US stocks when the US economy is looking shaky. So I'll answer that one unless anybody has got a question that they would rather I took before we wind things up in a few minutes. Okay, so our member asked, the lady who asked this question, she was actually born in Brazil, and she comes from a place of like experiencing regime change in her parents' living history. So they remember when Pinochet was elected as under a democracy, and it turned into a dictatorship. The entire economy was destabilized, and it was a whole different ball game going forward to what they thought it was going to be. So she's looking at President Trump's way of leading and looking at it and thinking, this looks similar to something I've learned from my history books and don't like the look of. And she's sort of saying, why are we still so invested, like with a leaning towards North America when all of this is going on? Shouldn't we be like, Shouldn't we be dissolving that? And the truth is that she is in a passive portfolio, and we are fans of passive investing. It's also evidence-based investing. So it's basically, a globally allocated portfolio will look at the evidence of decades of data and say, right, okay, the way money's been made in the past in this capitalist mechanism are here and here, and we're leaning into these allocations proportionately to how important they've been to total returns in the past. So it's evidence based on data that is dictating the current asset allocations in global portfolios. What they do not try and do is predict the future. They invest and allocate based on the evidence of history. So you're right, if it's all going to be different in the future, then the portfolio is probably not allocated in a way that is designed to capture that change. It's allocated in a way that's designed to replicate the way money has been made historically over the globe. So that's one of the features of passive investing, not trying to time the markets based on evidence. And I would also add that Donald Trump's presidency of 4 years, in the size of the data sets that the evidence is based on, is a blip. So he's not likely to change the evidence of decades. In fact, we've got empirical data going back hundreds of years in his short term. So so there's that element of it as well. The capitalism sees Donald Trump as short term. It's been going a lot longer. So those are my kind of observations really on why asset allocation to America still looks the same as it did last year, even though the economy might not look as robust and reliable as it did last year.
So, Sam, on that then topic, so with American funds been having historic evidence of performing. So, should I, when it comes to Asian stocks, should I just jump and start purchasing Asian stocks just to benefit from low pricing at the moment, because obviously there's no any evidence of them performing? What's your point of view on that?
Well, that would be a prediction, wouldn't it? We don't know that Asia is going to perform stronger in the future and America will perform weaker in the future, and therefore leaning into Asia is going to give you a better exposure to a stronger economy in the future, because we're guessing. That hasn't happened. There isn't empirical data to say it is happening. So you would be predicting something. And the thing about passive tracking is it doesn't predict, it doesn't try to. The asset allocation is based on empirical evidence, data-driven decision making, and it's not trying to. The thing is that if you're right, if my Brazilian client is right, and there is going to be a big shift in where money is made globally in the future, and you get the guess right, you allocate your portfolio to the place or the asset class or thing that is going to do really well and then great. But what if you get it wrong? And that's the point really, is that all the evidence of actively trying to time and guess, all the research that goes into trying to do your best guessing, doesn't add up to a greater return than simply tracking. By the time you add in the costs and those costs filter through to investors, it's very hard for the fund managers to get it right often enough for us to rely on the fact that they are going to do better than simply tracking the market. So, I think it's big wins and big losses. If you try and predict something, you're going to get it right or you're not. And I think fund managers, experts, get it wrong as often as they get it right. And the consequence is the cost of the research, the cost of trying to predict the markets and get those bigger gains gets eaten up. The bigger gains get eaten up by that cost. So we end up in a situation where if you just track it, That's very inexpensive to do. It allows you to be very diversified, but it doesn't allow you to be ahead of the curve and in a position to, you know, to grab a very special gain by being in the right place at the right time. But it also avoids being in the wrong place at the wrong time. So, you know, it is a question of what philosophy do you want to follow? And I have clients who want to shoot for the stars. They don't want to follow the market. They want to beat it. You know, that's what they get out of investing, is beat the market. And, you know, and that sometimes they have periods where it looks like they're achieving that until you take the costs off. Then they're generally back to where they would have been if they were tracking. But they love having a go. And as I say, this particular client who asked this question, she's got a very emotional reaction to what's going on at the moment. And some of what's driving her thinking is, I just don't want to be here again. Like, I want to try and get ahead of this. So we've been talking about how she might do that with some more tactical asset allocation.
Interesting.
Yeah, it is. It is. And everybody has a right to run their portfolio so as it suits them, their preferences, their beliefs, you know, and we will do everything we can. We serve what our clients want. So, you know, we don't dictate how it should be done. We'll give you our best guesses. We love evidence, data, and you know, we will always try and analyze something and give you the risks and the benefits and the costs and the rewards. So it's kind of, you know, a balanced opinion. But some people do it differently to others, and we don't, you know, we don't think one's better than the other. We exist to serve and make sure you get the thing that serves you best. So. Okay, well, I think probably I'm certainly running out of steam myself. I think I started with a bit of an empty tank, to be honest, and I'm definitely feeling a little bit jaded now and wanting my dinner. So I'm gonna bring it to a wind up now. I'm going to thank you all for your participation. Been some great questions. And just remind you that we've got some events coming up. So on the 20th of June, we've got a Habitude session. Now that's a fairly intimate, small coaching session where we've still got 2 places left. So that's the 20th of June. If anybody wants to jump on one of those places, that I'll be running that session. And it's where you learn about your strengths and weaknesses around your attitudes and habits with money. So on the 27th of June, we've got our Finance on Friday session. This one is on freelancing and self-employed. So how to manage your income and set up your pensions and protect your future. And our next Ask the Advisor session, so bringing your questions in this forum, is on the 11th of September at 7 o'clock. So the 27th of June, Finance on Friday, on freelance self-employment, is at 12 o'clock in the afternoon. And the 11th of September is at 7 o'clock in the evening. The Money Habitudes one on the 20th of June is at 12 noon. Carol is dropping those links in the diary for us. Thank you, Carolyn. She's part of the Women's Wealth team. And I would like to say thank you very much to Yulia, and Selena's been there as well to back us up in case we didn't know the answers. Thank you, Selena. And yeah, a very big thank you all for coming, and we do like to be your best financial friend. So thank you for giving us that opportunity to be useful, and I hope to see you all again soon.
Thank you, everyone.